The ongoing transition to renewable forms of energy and the electrification of industry, alongside the rollout of digital infrastructure to facilitate the exponential growth in data traffic, presents a strong fundamental demand outlook for a number of industrial metals and minerals. Battery electric vehicles, for example, require over 3 times the amount of copper when compared to an average combustion engine vehicle. And this figure does not include the charging infrastructure that will clearly be needed to support this growing fleet. Wind turbines are also estimated to require circa 10 times the weight of specialty metals and minerals to produce the equivalent output of a natural gas-fired turbine. The mining equity sector clearly plays a critical role in enabling these huge long-term trends, evidenced no more clearly this month in the ongoing news flow surrounding BHP's approach for Anglo American, a large part of which is focused on the company's attractive copper assets in Latin America. Today we discuss the various moving parts needing to be considered when looking at an investment in the mining sector. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel. We hope you're enjoying the discussions so far, and you can get in contact with us about any of the topics discussed via our email address, investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. Today we are joined by Olivia Markham, a member of the natural resources team at BlackRock and co-manager alongside Evie Ambro of the London-listed BlackRock World Mining Trust. Olivia joined BlackRock in 2011, having previously been head of the European mining team at UBS, as well as spending several years within industry in the mergers and acquisitions team at BHP Billiton. BlackRock World Mining, ticker BRWM, is a £1.2 billion market cap UK investment trust, and as the name suggests, invests in a global portfolio of mining and metal securities. The team use an unconstrained approach and can invest up and down the market cap scale, across geographies, and the various subsectors of the mining equity sector. The company also uses a number of the capabilities of the investment trust structure to its advantage, including a modest use of leverage to enhance long-term returns, and the ability to explore unquoted investments, such as mining royalties and debt, to enhance the yield of the trust, and some pre-IPO opportunities, which Olivia touches on in our conversation. There are a number of factors to consider when assessing the outlook for commodity prices and subsequently the attractions of the equities of mining companies, as well as clearly environmental considerations of this extractive industry. It is therefore always interesting to discuss these topics with a specialist team investing in this area. Olivia, good afternoon. Thank you so much for sparing some time. How are you doing?
Very well, thank you.
So Olivia, our kind of standard first question attempts to get a bit of an insight into you and kind of what you've been working on recently. So I wondered if there was a few people have kind of added a kind of book recommendation in here or an article that they've been reading. Is there anything you can share there?
Well, a range of books I read, but one that maybe is relevant for this this audience is a really interesting book called Material World by Ed Conway. It's actually a great read, and it really highlights probably our underappreciation of just how important materials are in our everyday life. That how it's, being the source of huge value creation for well-known families today, how it's enabled industries, how it's enabled semiconductor industries, and it's absolutely critical to things that we often take for granted. So I'd really encourage people to take a read if they have a chance.
So, always good to get a book recommendation. Olivia, I know you're obviously constantly meeting companies in the sector. Are there any kind of anecdotes from recent meetings that you've had that you could share? Just anything interesting coming out of companies you're meeting at the moment?
So we've done something that's been actually a little bit different recently, and we've been thinking more broadly around, I guess, some of the enablers and the requirements of the huge amount of data centers that will have to be built as a result of AI, and also the power requirements in order to power these data centers. And what has been quite interesting is that the work that we've done, it shows that somewhere between 20 to 40 tons of copper is required for every megawatt of data center processing power. And as we go up to these more kind of higher, power requirements under AI data centers, that increases further. So when we start to think about kind of the amount of capex going to data centers, the projected growth there, there's big estimates out there that we're going to need more than 2 million tons of new copper supply through to 2030 as a cumulative amount. So this has actually got the potential to sort of increase demand by a couple of percent, which, given how tight the copper market is today, the supply deficit that we see, that's another supportive factor that, in all honesty, a couple of years ago wasn't on my radar to think about for a driver of the copper market.
Yes, we've actually got some interest in the digital infrastructure sector, such as data centers. We may well be doing a future episode dedicated to that specific area later in the year. But it certainly does look to us that we're still very much at the early innings of the growth in the requirement for capacity there. I think there was a study by McKinsey, I think, to put that power consumption in context. Some of these very large hyperscaler data centers, I think, use as much power as 80,000 homes, and it's not just kind of purely powering all those servers. It's a good chunk of that consumption is in the cooling of these facilities, because you've got to keep things at the right temperature to operate efficiently. Olivia, I wondered, I thought what we might do is split the kind of first part of this discussion into two, and first of all look at the demand side of the commodity landscape, and then we'll kind of move on to the supply side. But in terms of that, the kind of demand side factors impacting commodity markets at the moment, it feels like we're currently battling with those kind of shorter term headwinds of a slowdown in China, with the medium to long term tailwinds of all those structural trends, some of which we've kind of briefly touched on already: the energy transition, digitalization. Are you able to summarize your kind of general thoughts on the current demand picture?
So we spend a lot of time thinking about those sort of longer term demand drivers for the sector, and as you outlined, they are very powerful mega trends out there. We have the energy transition. People are increasingly beginning to think about the amount of data center build out that we're going to need with AI. There's still ongoing urbanization in developing countries. And there's also this sort of move to bring on, manufacturing back on shore. So we see a number of quite positive underlying trends to support demand over the medium to longer term. When we think about that short-term demand picture, naturally, people do tend to focus in on China. And China's, it's really interesting, and it's changing. We have seen certainly weakness in Chinese demand for certain commodities over the last couple of years, and that's been primarily linked to their property sector, where property new starts have been declining steadily now over a couple of years. But actually, what you see is that manufacturing activity, investments into renewable infrastructure, solar, wind, investments into EV, investments into the grid, has actually been remarkably strong. So actually, I think we're kind of at this quite interesting point on China, where what our mental model of the old drivers of demand, being largely property, more traditional infrastructure, is changing into these cleaner, renewable areas. And that actually still looks very positive from our point of view.
And so let's maybe move on to the supply side then. I mean, are you able to kind of give a kind of similar summary on that side of things? What are the kind of the pipeline looking like in terms of supply?
Yeah, so the supply side is an area where we can really build conviction, in our view, that the structural underinvestment that this sector has had into new supply growth over the last 10 years has fundamentally tightened markets for a number of the commodities. The most clearest example of this at the moment is copper. We have very few new projects that we can see coming in on the horizon over the next couple of years. We have a market today which is forecast to be in deficit. We have very low levels of visible inventory. And the challenge that we have looking forward is that demand growth is running at a faster pace than supply growth. So that gap, that deficit continues to grow.
Olivia, my next question is regarding the kind of financial strength of the mining sector. Obviously, we know that in any industry, irrespective of whether you've got very strong fundamental drivers, a very compelling kind of supply and demand backdrop, you still need companies that are financially sound to be able to benefit from that backdrop. And obviously the economic environment has changed quite markedly over the last 2 years. We're no longer in a low or zero interest rate environment. And the mining sector is obviously a very capital intensive sector. We've heard you talk previously about how the sector has kind of significantly improved in terms of capital allocation discipline and better balance sheets. But I wondered if you could kind of talk us through how you think the sector is set at the moment, given the kind of change in economic backdrop.
So we have seen a very distinct change for good in the balance sheet strength and quality in this sector. I think one of the challenges that this sector had is, they built up so much debt. They committed to so many growth projects at the top of the cycle, post the super cycle, which left them with, very, very negative balance sheets at the bottom of the cycle. To that, in turn, crystallize this change in capital allocation frameworks where companies have really focused on strengthening their balance sheets. If you have a look today, the mining sector has one of the strongest balance sheets out there, and many companies have net debt to EBITDA ratios of sub 1 time. So the sector is, very well positioned, very financially stable to weather that natural volatility that we do see in commodity prices, which we believe should deserve a higher multiple valuation across the sector. Yet sadly, that has yet to come through.
Yeah, Olivia, can you maybe touch on valuations? I mean, where are we at in terms of the kind of the broad sector, kind of relative to history, or the kind of universe that you're looking at? What the valuations currently look like?
So the mining sector continues to trade at a discount to its own historical average multiple, and a very meaningful discount to the multiple available to that in the market. If we have a look at something like dividend yields, the sector trades at about twice that of dividend yield that's available in the broader sector. So yes, we certainly see value on like the full range of kind of valuation metrics that you would traditionally use to assess the sector.
Could I ask you to maybe touch on how you approach environmental issues with this portfolio in this strategy? It's kind of clearly highly relevant to the mining sector, which faces the challenges of being an extractive industry. But it's often finding this balance because the companies are obviously highly critical to providing the resources that we need to execute the energy transition, for example. How do you approach environmental issues when you're investing? And I wondered if you're able to give any examples of how underlying companies are looking to improve operations from this perspective.
So we've always taken a very strong view and spent a lot of time in our investment process really thinking about companies' approach to ESG, because as you say, an extractive sector, it's naturally sort of water intensive, it's carbon intensive, it operates in more challenging jurisdictions, has a big impact on the local community. So it's absolutely essential for this sector to get, their ESG right, because if they don't, they lose that social license to operate. And if you lose your social license to operate, that has a very, very big negative impact on your share price. So for us, the way that we get an edge on this, it's not by reading, glossy sustainability reports. It's getting out on the ground and going to the assets, understanding the challenges, seeing actually what true operational performance is like in practice. So that's something that everyone on the team really does try to get out to do, and it's a great part of the job. I think an interesting way to look at this sort of some of these where an environmental controversial issue has resulted in a negative share price reaction. I think it's really important to see what companies do in response to that. And we've had a number of examples. We could say in the case of Vale, post the tailings dam tragedy at Brumadinho, I would say a similar kind of response has been taken from Rio Tinto, post Juukan Gorge, that they really have gone on the front foot and put ESG first and really trying to restore that pact with the community, that pact with society, to deliver on their commitments to kind of rehabilitate and restore. In each of those scenarios, we have had confidence and conviction that the companies are doing the right thing. People on the team have actually gone out and visited those individual assets. I think as they have looked to rebuild that trust, that social license that they have, that has in turn helped the performance of their share price.
Olivia, I wondered if you could give us a kind of brief summary of the types of investments that are in the BlackRock World Mining portfolio at the moment. And obviously, BlackRock World Mining is a London-listed UK investment trust, so a closed-end fund, so it's not impacted by kind of daily or weekly inflows and outflows of investor money. And one of the attractions of that to us is that you guys are able to take a kind of longer term approach to managing the investments, and what that means is you're able to invest in some other opportunities, for example, unquoted investments that don't have a public listing. I wondered if you could kind of talk us through. I know the trust has invested and continues to invest in those sorts of opportunities. I wondered if you could talk us through what those bring to the portfolio and the reasons why you look at those, and also why you're doing that. Maybe kind of run us through the kind of primary exposures that you've got within the portfolio at the moment.
Yeah. So one of the benefits of having the investment trust structure, the World Mining Trust, is that we do have these additional tools that we can use to try and really maximize the investment opportunities that are available in the mining sector. So you're right. We do have private investments. We have investments in individual royalties. We are able to use gearing to get in and out of the market. We also can do some option writing. We can also own some commodity futures as well. So we do look to take advantage of all of those different tools. The bulk of the portfolio is in the publicly listed equities. In turn, the bulk of the income generated from the World Mining Trust is generated from the dividends of those underlying holdings. But what we've been able to do very successfully over the last couple of years is really generate some outsized returns from making some really successful investments in pre-IPO companies, so private companies, which have had a IPO, within 12 to 18 months of our initial investment, which have, in both cases, resulted in more than 100% return. So I think this is a really useful tool that we have. We're selective, we're opportunistic in how we do it. But I certainly like the fact that, we have a whole range of features available to us, once again, just to try and really take advantage of the full global suite of investment opportunities in the sector.
Olivia, our kind of standard final question is one that asks what your kind of highest conviction area is at the moment. And I wonder if there was kind of one particular area of the portfolio that you would pick out as being kind of an area that you're most positive on at the moment.
Yeah, I mean, for me, and I've had this call this year, but I'm particularly positive on the copper sector, the copper equities, but also the copper price. And part of that has now begun to play out. I did a visit to Chile in November of last year, and it was very clear to me that we've seen a structural change in the capital intensity, the cost of building new copper projects. What that means in turn, given how fundamental copper is for the energy transition, we're going to need more of it. It's going to cost more to build, so we're going to need a higher copper price to kind of effectively incentivize that material into the market. When I then start to think about higher copper pricing and I look at the value of listed copper equities, there was a clear disconnect. Now, we're seeing quite a good move in some of these names year to date, but that's been my conviction call. And to be honest, I continue to see further upside in this story, because I still think that price needs to live up to incentivize new projects into the market.
Still see good value there. Yeah, thank you for that. Olivia, as always, really interesting to chat to you. Thank you so much for sparing some time. Thank you. Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.